Okay, right. So the best thing to do is for this question 11, is I actually think to draw a little bit of a T account to show the ins and the outs. But before we do that, let's discuss the ins and the outs, right? If you think about a normal standard asset account, you're given the opening balance here. You're told you have 15,000 at the beginning. So if that's your inventory account, if you want to call it that, you have 15 at the beginning, don't you? The 1st of December. So it's an asset debit, of course. Then you buy some more. So you have some more coming in, right? And then you issue out to production um, a certain number. So this leaves your warehouse. This leaves because it's leaving, isn't it? So we credit it. So the warehouse will have their own debit account. We're not interested in their receipt account. We're just interested in this account. Then some of this material goes bad, so we write it off, right? So we're reducing it, so to speak. And then some of the material we sent to the warehouse is returned to us, so we now have it coming back in. So crediting the the production department, and they're sending this back into the warehouse. That's what this means. And then we actively return some of this back to the supplier. So we actually return some of this material that we initially bought back to the supplier. So the question is asking fundamentally how much is left, and I've already started trying to put that together on a PowerPoint so that you can see what's going on. It started with 15. That's the 176. That's the 9 that was returned by stores, and then you have all of that. And so when you look at the difference between, of course, these two areas, you get a difference of 23. And so when we come over here, we can see clearly that we have a closing balance of 23,000. 12, really an exercise in double entry, isn't it? We have the first one here. So you're looking at these and you're just thinking who's receiving the goods and who's let them go. So if you're receiving, it's a debit. And of course, if you're letting them go, it's a credit. So who's receiving the goods? These goods are returning to stores, right? They're coming back to stores. So this is return. So we know we're definitely debiting stores. And the code is, of course, 4,000. It's for 20 flap straps at £50 each, and that's of course £1,000. And who's letting them go? That code is 5,000, and that's also for £1,000. And now what we intend on doing is paying our suppliers. So our suppliers, we have a supplier which is technically a purchase ledger control account. We are paying them. So if you look there, you can see the code for the purchase ledger control account. That's 3,000, right? So we will pay that supplier and thus debit that account. So that's 3,000 by the 75 times 75 times 15, which is 1125. So we have 1125, right? And of course, we are crediting bank because we are paying, and the code for the bank is 2000. We have 2000. Crediting bank 1125, and that's what's happening with that, right? We're paying. So debit the purchase ledger control account as you would, and credit bank is what's happening there. We have a payment of receipt on fuel, so we pay 1,200. We know these are both 1,200, 1,200. That's what we pay this out of the bank. So let's deal with the bank first. 2,000. That code is 2,000. But of course, we are receiving into our stores some fuel. That's what's happening here. So we have into our stores department, we are receiving into the business fuel coming in. We then issue, if you like, out of stores to the short haul department a 300 times £1.23, 300 times £1.23, and that's 369. So we issue out of the stores department the 369, and that's going to the direct costs of fuel to make this in terms of our wheels. Yeah, what do we do? Yes, to enter into the cost accounting. Yes, so we are sending that to the direct costs of 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 the business. So that's what that is then, going towards fuel, your haulage business. So that's a direct cost. Direct cost. Variable, if you like. So that's the sort of a good signal for it being a direct cost. And that's question 12. So again, this is really just double entry, ins and outs, and just take the same principle to build on that. Conclude this set of this video with question 13. This says the double entry for an issue of indirect production materials. We need indirect production materials. That's what an issue means. What happens? So if you look at this, really, what they're really telling you here is that you're dealing with production overheads. How do we record that happening? Production overheads. So in effect, really, debiting the production overheads is the best answer here. I mean, this is work in progress. That's not indirect production. This is work in progress. That's not indirect production. This is the receipt of the actual materials that we need. But in terms of the account for dealing with production, indirect production overheads, we have one here clearly. So whatever you have, you would come out of the materials control account and put it into the production overhead account. Separate clearly this expense clearly as a production overhead, if you like. So your answer there is B. You debit production overhead control account and you credit the materials control account.